This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com. As part of our ongoing series on financial repression, I have Dr. Mark Thornton joining us this morning. Dr. Thornton is a senior fellow at the Mises Institute in Auburn, Alabama. Welcome, Mark.
Good morning, Gordon. It's a pleasure to be here with you today and to be on your show.
Well, it's our pleasure, and I thank you very much for the time. Mark, maybe we could begin with you giving our listeners a brief overview of your background and the Mises Institute for those who aren't familiar.
Well, I'm a senior fellow here at the Mises Institute in Auburn, Alabama, home of Auburn University. I received my PhD in economics from Auburn University and teach there as well. I'm the book review editor for the Quarterly Journal of Austrian Economics. I'm a regular contributor to the Mises Daily, which is a free daily article available from Mises.org. So I encourage all your listeners to go to that website and to get informed about the Austrian School of Economics, because the Mises Institute really is the home of the Austrian School of Economics. I've written several books. Most of them are available for free PDF downloading on Mises.org. The Economics of Prohibition, Tariffs, Blockades, and Inflation, The Economics of the Civil War, The Quotable Mises, an essay on economic theory, and of course I've also contributed to our Quarterly Journal of Austrian Economics on a regular basis, and all that's available for free on Mises.org for your listeners. I
had Doug French on too from the Institute, and it was a very well received video. Actually, when we first started this whole series, Mark, we're here today to talk about financial repression and to discuss it. And maybe we could kick it off. Could you explain to our listeners what this macroprudential policy of financial repression is, if you could define it at least in your words?
Well, it's of course an enormous topic. It's of course the topic really of the day and of our modern economy. It's a very academic sounding term, financial repression, macroprudential policy. But what it is basically a financial scam of the government over the private economy. And Gordon, we're living through a period of the last couple decades where governments, not just the U.S. government, but the European Union, Japan, China, and most of the major economies have been using this macroprudential policy to take advantage of its citizens, of its savers, of its investors. They're printing money, they're issuing enormous amounts of debt, they're suppressing interest rates, and all of these policies are designed to really exploit the worker, inflating the value of the goods that they buy, but obviously wages are not keeping up. Interest rates have been suppressed to incredibly low levels. I was in my bank last week and the 5-year CD was 0.2 of 1%. So if you take away taxes and inflation, savers are actually getting a negative rate of return. And so through various means and through various policies, in a very much cloaked atmosphere where nobody really knows what's going on, the government is extracting resources for itself at the expense of the common man.
You wrote an excellent article on how central banks are waging war on your savers, and in it you defined who the winners are and who the losers are. Could you help our listeners with that? I think a lot of them know who the losers are right now.
Well, I mean, you can well imagine that with interest rates at incredibly low levels, this helps banks, this helps large corporations, this helps governments, and any kind of large borrower. And of course, the federal government of the U.S. is the largest borrower on the planet with 17 plus trillion dollars in official debt, and of course, enormous unfunded liabilities going forward. And so the borrowing side are the big beneficiaries. The big losers are primarily savers and consumers and producers. As I mentioned earlier about savers, you're getting a very low rate of return on your savings, your CDs, your money market mutual funds. All of those are basically zeroed out. And then, of course, when you get your savings returned, they've been affected by price inflation, depreciation of the currency, and so forth. And so savers, laborers, producers, entrepreneurs are all losing in this environment of financial repression, and it shows that the economy, the worldwide economy, is suffering as a result of this. They're shackled in by policies of inflation, zero interest rates, quantitative easings, heavy regulations in the major industries of healthcare and banking and that sort of thing. And so it's an enormous problem. It's not the typical inflationary policies of the past. This is an enormous issue in the modern context because the numbers are just so enormous in today's world economy.
Mark, with the cornerstone of the capitalist system is savings, and savings being reinvested into productive assets that create stable growth. If we're penalizing savers to such an extent, aren't we jeopardizing longer term the capitalist system? Or at
Absolutely.
least a lot of fallout from it?
Yes, we are in so many different ways. We have a fiat paper money system, and money is very much a cornerstone of the market economy. That's in jeopardy, and if that is lost, capitalism will be lost. And then, as you mentioned, the whole process of economic development requires consumers to forego consumption and to provide savings in the resources, the real resources, not just government printing things up type of policies, but actual real resources being conserved and saved today so that entrepreneurs can put those resources to work building our future. But the savings component is being repressed. Entrepreneurs are being very much discouraged by current taxes, regulations, and then the threat of higher inflation and higher regulations and, of course, higher taxation in the future. And so what you see in the U.S. economy is very much a reluctance on the part of entrepreneurs to do this investing into the future. We've seen entrepreneurs leaving the United States and setting up production overseas, establishing firms or subsidiaries overseas and not willing to bring their profits back into the U.S. And so there's lots of visible signs that this financial repression is not just accepted on the part of everybody, but people are trying to avoid the negative ramifications of financial repression. So you're seeing people leave the United States. You're seeing people rescind their citizenship. You're seeing corporations and entrepreneurs move operations outside of the U.S. You're seeing people investing in gold and things of that nature to try to avoid the inflation tax and try to soften the blow from a lot of these policies. So people aren't necessarily accepting it. They're trying to find ways around it. Obviously, people have taken their money out of savings, out of CDs, money market accounts. they've put them in the stock market as the only alternative. And that the only reason the stock market is so high is because people have moved their savings out of those stable, safe assets, and they moved them into much riskier forms in terms of stocks. And of course, the bond market is in a bubble as well. So that's the financial repression spreading throughout markets. And of course, the hedge funds and the big investors, they can borrow money at low rates and then plow that money back into risky assets in the stock market. And so far, people are holding their own to a large extent. But of course, the stock market is, as it says, a very risky place to invest your money. And we've already seen a large upswing in stock markets in many of the countries around the world. And but those assets are still at risk.
What's frightening, any of the measurements I look at, they're actually more elevated than the previous tops we had in the dot-com bubble and in the housing run-up to the financial crisis. But when I look at, when we can debate those valuation levels, but I see pension plans trying to chase yield, having to take on more and more risk, buying more and more weighted into the stock market. And a vast majority of public and private pensions are underfunded in the first place. Any kind of significant drawdown, and we could have pension crisis of massive proportion. Am I overstating that?
No, not at all, Gordon. It's pensions, both public and private, and it's also insurance companies. These are huge financial areas in the economy. The stock market gets all the news coverage, but the bond market, the insurance market, the pensions, all of those are huge components of the financial system. And as you suggest, if you survey all the measures of valuation properly conceived, what you find is that the stock market is at very, very high valuations. And that's, they're somewhat, and even those measures are somewhat understated by the fact that, for example, corporations have bought back, have used debt to buy back shares. And so the PE ratio looks a little better than it actually is because a lot of the shares, on a per share basis have been eliminated from the marketplace. And so the stock market is very highly valued. And as you suggest, pensions and insurance companies have had to stretch their imaginations in order to keep their books in order. And pensions are, generally speaking, certainly the public ones are underfunded. And so any losses that would occur today in their portfolios would put them in a severe state. And, the contributions, for example, of state employee unions, typically if there are losses, then taxpayer contributions have to be increased. Okay, so that's the last thing you want to do is increase taxes in a time when the stock market is coming down. And of course, the measures of the economy, generally they're typically flawed, but they're all registering, several of them are registering negative results, not meeting expectations and things of that nature. So the financial repression seems to have gotten to the point where it's really starting to bring the U.S. economy into negative territory. And of course, we're not the only ones. The Japanese, who have really gone bananas on all these policies, they're falling into negative territory in Europe as well. So a lot of the major economies are either falling into negative territory or are falling below expectations. Even China is not meeting its expectations. And so despite record stock markets over there, the Chinese themselves are very worried about what's happening to their economy.
There's clearly a global slowdown, I would say, of significant proportions well underway, and you just can't hide from that. And help me with this. When I look at quantitative easing and the various 1, 2, and 3 that we've had, it in a 70% consumption economy, which the United States is, it's really about, with low interest rates, increasing or maintaining consumption or bringing demand forward. Future demand, that's what debt is, taking future demand and bringing it forward. And we've done that. But at some point, when demand goes up, supply goes up typically to match it, my basic supply and demand curves. And we've had this massive build out around the world to match this U.S. consumption and this demand that's been brought forward. But the moment, an old manufacturing guy like me, the moment I start to think the demand is slowing, I cut my commodities, I start cutting inventories, I start pulling back costs, and I've seen that commodities drop, and I see this excess global demand, or supply rather, that's out there. And corporations are not seeing it on their top line. Their sales are down. They're seeing margin issues. They're being hidden because of these earnings per share. Is quantitative easing and this money actually creating the whole problem right now? That is the slowing of the global economy, or has previous actions?
Yes, it's a lot of it's tied into the accumulation of debt. Governments have been able to borrow, especially the U.S., but other governments as well. They've been able to borrow, and other people have been able to borrow at artificially low interest rates. And so there's been a lot of investment in the private sector and in the public sector, in the semi-private sector, that is not justified by the price system. It's only justified from the fact that there's been this enormous quantitative easing. And every time they do this quantitative easing, of course, stock markets react positively, but the real economy ultimately does not. China is probably the best example of this because they have the most rigged system, where they've expanded the public sector and the semi-public sector an enormous amount. So the GDP in China, basically the central committee decides what the growth rate is going to be. Then they tell the provinces what they need to grow. And then the provinces borrow money from the state banks in order to finance all sorts of projects, a lot of them in the public sector and infrastructure and things of that nature. So they have an enormous accumulation of infrastructure and housing and things of that nature, but it's not really valued by the marketplace. And so all they've done is they've built capacity and they've built debt, but none of it has been along the lines of market determination. It's all been along the lines of basically the state setting guidelines, having a centrally planned economy. But ultimately, this is really starting to show now in terms of the world economy, not just the U.S., but around the planet. And Gordon, I think the best indicator of this global slowdown is the Baltic Dry Shipping Index, which is an index that monitors how much it costs to ship goods internationally, for example, through the Panama Canal, through the Suez Canal, around the Africa and so forth, those long distance shipping runs. The Baltic Dry Shipping Index typically is a number between 1,000 and 2,000. At the height of the economic bubble in 2007, that Baltic Dry Shipping Index was 11,500, which meant there was an enormous amount of international trade and economic activity going on. Now, in 2015, the Baltic Dry Shipping Index has been down into the 500 level, at a level that it's never been down that low in its history. So that indicates to me that economic productivity and trade are greatly diminished. There's less economic activity and there's less global trade, which is, typically a sign of economic stagnation rather than a sign of economic strength. So that's one of the things I keep my eye on to measure the temperature of the world economy is the Baltic Dry Shipping Index. and also, of course, the price of oil.
You know, we've have so many distortions from the things we're talking about that we now have a lack of price discovery, we have mispricing of risk, we have degrees of malinvestment of this alignment of supply and demand. And, you know, I don't think we've outlawed the business cycle where we occasionally have a recession. And we've, you know, typically every 5-6 years or sooner you have one. And we've been in this recovery for 6 years now, if we can call it a recovery. And we're seeing all the indications that could often lead to a recession. I'm not saying that's the case, but with interest rates at zero, what bullets does the federal banks have to offset a normal falling business cycle? Ever mind one that could be potentially a global in scope.
Oh, I agree. And you know, the fact that the Fed has not been willing to increase the federal funds rate, right now I think it's at 1.4%. And their big deal is to raise it to maybe something over 0.25%. And yet they're backing down, despite the fact that they've made all of their targets here in the U.S. Now they're complaining about a lack of growth in Europe and a lack of growth in Japan. It seems as if it's going to require worldwide economic perfection before the Fed is going to be willing to raise interest rates. And I know why they're afraid, because they realize that the real economy is not healthy in any respect. The labor market is not healthy. The real estate market is not healthy. The financial industry is not healthy. So much of our economy is really on fragile grounds. And it's not just us. It's a global phenomenon. And, you know, they can't outlaw recessions. They could return to more quantitative easing. They could hold interest rates at zero. But you're right, they don't have much more to offer. And a recession is knocking at our door as we speak here this morning, Gordon.
I believe that too.
In the U.S., you know, economic growth in the first quarter was non-existent or probably negative, and things have not gotten any better since then in terms of final goods sales, intermediate goods sales, inventory wholesales, imports, exports. Wherever you look around the economy, the numbers are not good. Now, there is a way out of this. I mean, if you want to turn to the Austrian prescription...
I was going to ask you about that. What are the solutions here?
Well, it's just the old-fashioned approach to things is that the Federal Reserve needs to get out of the interest rate market and allow markets to work there. The federal government has to balance its budget in terms of cutting back spending tremendously, and to signal to market participants that they're not going to have their taxes raised, and that the central government is going to do something about the national debt and the unfunded liabilities. I mean, those are all hard policies to enact for politicians, but if they do, I mean, if they just did them and said, this is how we're going to address these problems going forward, you would immediately stabilize the economy and encourage people that, you know, to invest. And of course, we're going to have to go through an enormous deflation in the economy, which means asset prices, real estate prices, land prices, all of those are going to have to collapse. But with very low prices on capital and declining wage rates in the economy, entrepreneurs will all of a sudden discover an enormous new set of opportunities because generally speaking, in a deflation, consumer goods prices are relatively stable, wages fall, capital goods fall enormously, and land prices fall, warehouses and all that. And so entrepreneurs are going to be able to come in and swoop in there and put labor and capital and land together in new formulas to deliver new products to consumers or the existing products at a much lower price. And so it's all about deregulation, balancing your budget, allowing markets to work, and that's painful because it means unemployment, it means lower wage rates, it means falling home prices. It means falling stock prices and all the rest. So the people who have benefited from this financial repression, the top 1%, the bankers and the hedge fund owners and managers, they're going to lose enormously. But for the common man, it's going to be painful, obviously. But ultimately, we will be in a better place in a very short period of time, I think, if we enact that set of policies and immediately put into work policy proposals which will fix the existing problems that have been created by this group of economists and central bankers and bankers and banksters and all of the people who have benefited so much from the last couple of decades of financial repression.
Is the core problem of what's caused this two things? We haven't practiced sound money, and we haven't, or rather, we've should be producing more than we consume, or flip a bit, we've been consuming more than we produce. And between the two, it's really manifested all of these things that we're talking about?
I think that's absolutely right.
Yeah, I was wondering if I'm being too simplistic.
Well, actually, I would take the simplicity one step forward and say that all of our problems are really the result of unsound money. When you're on a gold standard, governments can't engage in stupid economic policies, or the economy immediately feels a bite back from the world global economy. And so when you're on a gold standard, governments have to balance their budgets. They can't engage in enormous wasteful spending. And so one of the things that clearly goes out the window is going to war and having enormous empires. You can only finance those empires and those wars with debt and with access to fiat money. So you take that away, and all of a sudden governments have to balance their budget. It really pays savers to save their money because you're going to get a real return. And so the gold standard or sound money actually helps solve the problem of excessive unbacked debt in the economy on the part of both governments as well as individuals and corporations. And it really encourages them in the right direction, which is saving and investing in productivity for the future. And that's how we all get ahead. So sound money prevents government from causing all these problems, and it encourages, it's a natural encouragement to the types of things that we all benefit from in going forward into the future.
Yeah, it's the only mechanism that really creates a level of discipline, of fiscal discipline within a democratic system. Otherwise, Margaret Thatcher used to say socialism is about spending other people's money till you go broke. But in a democracy, we have people voting often for something that they think is going to be somebody else's money that's going to give them the benefits, and politicians who are not accountable giving away money they don't have to give away. And I may be overstating it, but when there's no fence to control it and call it sound money and fiscal discipline, it just leads to bad things over a protracted period of time, which you then fix with unsound monetary policies and fiscal policies and public policies. It would seem to me, you're a professional in this area, but just as a layman, it seems pretty obvious what the problems are. But I don't. Why are they not being addressed?
Well, that's a great question. That's why I'm here at the Mises Institute. I've spent most of my career here trying to get across that message. That's what your program is all about, is getting this message out to people who only have access to the mainstream media, and what they're giving you is what mainstream economists give them, and that's the problem. And the solution is here at the Mises Institute. It's people watching your show, getting that alternative perspective. And it's not just getting it, but I'm sure that a lot of your listeners, even first-time listeners, realize that, hey, these guys are making some sense, or this sounds more like common sense. This sounds more like bedrock that can actually get the job done, compared to this idea that we can, that Paul Krugman says what we need is a fictitious invasion of Martians to encourage voters to vote for massive deficits to build interstellar ray guns to protect us from this fictitious armada of alien Martians that are going to come to the U.S. So he really thinks that building something that's totally valueless is actually going to be something that's going to save the economy. That just doesn't make sense. But what makes sense is returning to what made you great in the first place, which was a free market economy here in the U.S., sound money of gold and silver, a limited central government of only a few percent of GDP, no standing armies, no overseas empires, all of that. The more we went into that direction, the more we got ourselves entangled and encumbered, and that's driven us literally to bankruptcy.
Well, Mark, we're up against our hard line. There's so much to talk about here, and I would have liked to get into a discussion of the Austrian School of Economics versus the Keynesian School of Economics, just to point out how some of this is well documented, well understood, and how it can be actually in many ways hidden from the public. Maybe not intentionally, just not enough education in this area. I know when I went to college and studied economics, I never heard of anything called the Austrian School of Economics. All I heard was basic. Well, it wasn't even called Keynesian. It was just this is what you were taught, and it's hard. It takes experience to see other schools. So I encourage our listeners to, take this a little further. The Mises Institute has tremendous information and knowledge here, but you got to invest some time. Mark, are there any key messages you'd like to leave with our listeners, and how could they learn more about your work, your writing, and the Mises Institute?
Well, our webpage is mises.org, and you can sign up to get an email every day with the Mises Daily article. We have everything from audio and video, lectures. The daily article is short and sweet. We have academic journals, and we have all sorts of books online. It's really it's the largest economic webpage in the world, and it's all free. We're open 24/7, 365. You don't have to register or anything. And we also, of course, have a Facebook page. We have a Twitter account, very popular. You can follow us at MISES. You can follow me at Dr. Mark Thornton, DrMarkThornton. And so we're out there all over the internet, and I encourage your viewers to come to the Institute and get educated in more in depth about the Austrian school and how it differs fundamentally from Keynesian economics.
And I encourage our listeners to do exactly that. It's worth the time, the energy, and you will quickly start to. It will be worth your time. Mark, thank you very much. There's so much to talk about. We'll have to have you back again. These times are going to get even more interesting in my mind this year and next year, as these problems just seem to get worse and worse without any clear solutions. So thank you very much for your time.
Thank you, Gordon. I would enjoy coming back on the program sometime soon.
Talk to you. Bye.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.